Order, and welcome to our one-off inquiry session on investment in the UK economy and the pensions scheme bill. And it's an absolute pleasure to welcome our panel of experts this morning. We have Jackie Wells, Jessie Griffiths and William Wright. And I know that I think it's you, William, that need to leave promptly at 10:15 for a Eurostar connection. So we will make sure that we do that. But perhaps you'd like to introduce yourselves and the organisation that you represent. Starting with Jackie.
Morning. Thank you, Chair. Jackie Wells. I'm an independent policy and research consultant. I've spent many years working in pensions. And I have several hats, but this morning I'm here in connection with work I've been doing with the Pensions Policy Institute on asset allocation in the pension sector.
Good morning, I'm Jessie Griffiths. I'm CEO of Finance Innovation Lab. We're a charity that works with experts inside and outside the system to try to improve government policy on financial systems.
Good morning. Thank you very much for the invitation to join you today. My name is William Wright. I'm the founder and managing director of New Financial, a think tank that I launched just over 10 years ago to make the case for bigger and, most importantly, better capital markets across the UK and Europe. We've been doing a lot of work in the last few years on UK pensions reform and also similar reforms going on in Europe.
A very warm welcome to all of you. We've all got some questions for you, but I'm going to kick off if that's okay. And I wanted to know about how pension funds invest their assets, thinking about the UK and internationally, and particularly in terms of the trends in this investment. Who would like to start us off?
Happy to start.
Okay, Jackie.
So, in terms of how pension schemes invest their money, I think it's important to start with reflection on what we do and don't know. And the fact is we know quite a lot. There's a lot of data out there, but it's not enough to really comprehensively map the assets of the UK pension sector with a high degree of confidence. We don't have consistent and we don't have complete data across the sector. We have multiple sources that are categorised in different ways and sometimes tell slightly different stories on the data. So that's scene setting. But there are some things we do know with a degree of confidence. So we have some confidence around private sector DB schemes because we have quite a lot of data. And on the whole, we know that they're heavily invested in bonds. About 70% of the portfolio is in bonds, with government bonds dominating that mix. But what's also happening, of course, is that there's a trend towards securing the liabilities of the schemes with annuities, buy-in annuities, which in turn invest in corporate bonds. So there's a bit of a transition going on there within and outside of private sector DB schemes as they mature. And we've also got listed equities and private market investments that make up a small proportion of the remainder of the assets. We know quite a lot about public sector funded DB schemes, particularly LGPS, although there are some slightly conflicting data sets out there. And in these funds, equities play a very large part, as do private market investments. And it's the private market investments that have been increasing in recent years, and maybe we'll come back and talk about that a bit more. We have some data, thanks to the ABI, on how pension annuity assets are invested. And we know that they're dominated by bonds, corporate bonds principally, from both the public and the private markets. And loans and private credit make up quite a substantial part of the portfolio. Data on DC is much less complete. So we have reasonably good data on the trust-based side, less good data on the contract-based side. And the contract-based side is still important to recognise in workplace. It's still bigger than trust-based. We can estimate that about half of the total funds are allocated to listed equities in totality, but that rises to about 80% when you look at the new growth default funds that are growing quite substantially. And bonds make up a quarter, while private markets represent 4 to 5%. I have to say it's really hard to pin down precisely these numbers. If we look at the totality of UK pensions, which is about just over 3 trillion now, we estimate a PPI that around 45% of the assets in totality are invested in growth assets, whether that's public or private markets. So I hope that gives you some sort of an overview. I know that William has some other numbers, and I'm sure Jessie has some data.
Jessie, would you like to? We're going to have to be a little bit tight on our responses. No.
Well, maybe I think the main thing I'd like to highlight is that the UK system hasn't been good at the pension system supporting business investment, in particularly higher risk business investment. And I think that's because it's based on two models largely that are not well suited to that. Well, this is part of the reason. So if we think about the defined benefit scheme, which ought to be good for supporting business investment because it promises people a decent pension at the end of it. Now, because most of those have closed and we're in wind down phase, they're actually shifted, as we've said, to safer assets, and so largely to bonds. So that's become a problem. And now the defined contributions, which most people have now in the default model, are not really, if you like, so much like a pension scheme. They don't promise you an income. They're more like a savings account. What you get out is based on what you put in. And because they individualize the risk in that way, they're unwilling to take, often, particularly the smaller schemes, unwilling to take higher risks investing in the kinds of business investment that the government or we might like them to. So I think that is a fundamental problem in the system, and that's why we're welcoming the government's moves to scale up the alternative, the collective defined contribution schemes, which can hopefully marry the two elements and promise an outcome that pushes the scheme to invest in a wider range of longer-term assets. And one study suggests that for the same amount of money put in, a CDC scheme could get you a 50% better return at the end of your when you reach retirement. So there's some hope there, but I think fundamentally the two types of models are not really the kinds of models you might want at the moment if you wanted to increase business investment, which I would argue is very important, not just for the economy, but also for pension savers.
William?
I would absolutely echo and reiterate what Jackie started with on the data side. It is very, very difficult, and for something as important as pensions and investment, it's striking how inconsistent the data can be. And just to build on those first two comments, I mean, it's really important that we try to think about pensions not in aggregate, but in terms of the different buckets within pensions, because they all have very different pressures, incentives, dynamics, risk tolerance, and therefore very different asset allocation. But one thing we can be reasonably confident of from some of the work that we've been doing, if we look at, for example, equities investment, what you can see is that in the big buckets of pensions like DC, which most people in the private sector will be relying on, or LGPS, the overall investment to equities, we think it's around 50 to 55% across those buckets. That's in line with their equivalent pension systems, equivalent pensions in other markets, other developed pensions markets. What's also clear, however, is that the proportion of that is invested in UK listed equities, in domestic equities, is significantly lower than most equivalent systems in aggregate and in each of the different buckets. Mm-hmm. It's also reasonably clear that the proportion in these different buckets that is allocated to private markets, to unlisted equity, to infrastructure, yes, as Jackie said, it's growing from a relatively low base, but that's also lower than in most equivalent systems when you compare DC in the UK to DC in other markets, or public sector DB to public sector DB in other markets. So the UK is a bit of an outlier in terms of how It's very much an outlier in terms of how the system is structured. It's also an outlier in terms of how assets are invested.
Thank you. I have another couple of questions, but I'd be grateful if you could write to the committee in response to that. So firstly, in terms of why there is this difference in investment in the UK, and secondly, in terms of the impact of the US-UK tariffs on this. So if you're able to write to us afterwards, that would be fantastic. But I'm going to hand over now to Amanda Hack.
Thank you, Chair. So we've obviously already started along this sort of path about how pensions are investing in the UK economy. So are there any more barriers to investing in the UK economy than what you've already explained? I think, Jesse, you started off with some of those barriers.
Yeah, I mean, I think maybe the thing to say is it's not just a problem with the pension system. So the UK has had the lowest level of business investment in the G7 for 24 of the last 30 years. And the fundamental driver behind that is that the financial system as a whole does not support business investment as much as it does in other countries. So it's not just pension funds, it's also banks and stock markets and other parts of the financial system. So we have a broader problem than just fixing the pension system or expecting the pension system to resolve it. And I would argue that the main reason for that is because financial sector policy is focused too much on growing the financial system as an end in itself and not seeing the financial system as a mechanism for delivering other ends, in particular supporting sustainable investment in the economy. And so I think that's a reflection of a broader set of problems. And one thing I would add then to, and others might want to talk about the pension system, and we've mentioned the different models, but I think it's also reasonable to say that the pension system needs a better pipeline of investable assets if we want it to do the kinds of things that we need. So, for example, Phoenix estimates that only 4% of pension investments are in climate-friendly investments, and we need to scale that up rapidly. And I think the solution to that doesn't lie within the pension system, but the logical partner for getting pension funds to scale up investment in the UK, in businesses and in the green transition, is the National Wealth Fund, but that's much too small. So the UK Infrastructure Bank released £1.7 billion in its last year, and the German equivalent KfW released 68 billion. And it would be perfectly possible for the National Wealth Fund to grow to that size if it could issue its own bonds, and then that would provide a safe, secure asset for pension funds to invest in. And I think that would be the way to try to support pension funds to do the kinds of investments we want them to do.
Lovely, thank you. Looking across the sort of domestic example and how we can compare to other countries, for instance, Canada and Australia are often used by the Chancellor. How does it compare with those countries?
Your best, please.
I think it's really important to make it clear, not comparing the UK with Canada or with Australia, but the different buckets. So LGPS, or public sector pensions, the best comparison is public sector DB in Canada, the Maple 8. What's very clear there, I mean, the key differences, first and foremost, is scale. I mean, the Canadian Pension Reserve Fund, CPPIB, is managed as one fund. It has roughly the same value of assets under management as the entire LGPS scheme in England and Wales, which is fragmented, which is split between 86 different administering authorities. That scale enables these pension schemes to take a broader approach to asset allocation. Often they are doing private markets, unlisted equity, infrastructure investment. They're doing that in-house because they're big enough to do so. And then that translates into having almost 3 times as much allocated to unlisted equity and infrastructure. About 35% of the Canadian public sector DB system is in those assets, compared to about roughly 12% plus minus a bit in LGPS. And we see a similar thing in Australia. The DC, the supers in Australia are much bigger. They've been going longer. Contributions are much higher in Australia than they are in the UK. Employer contributions, I think, have recently gone up to 12% minimum compared to 3% required in the UK. So they're bigger, and again, that gives them this consolidation, this scale, gives them the opportunity to invest in a broader range of assets. And Australia and DC are mid-teens in terms of unlisted equities, infrastructure investment, compared to maybe 2 or 3% for UK DC. So there's very clear differences, mainly embedded in the structure of the different systems.
And we've also got Canadians investing in UK infrastructure. So how are they able to make such large investments and our pension companies don't?
If you're, let's say you're CPPIB, and I think you've got about 400 billion Canadian under management, a bit more, then, and 20 or 30% of that is allocated to infrastructure, you are able to make investments with a deal size of hundreds of millions of pounds. I can't remember which fund that it was, but I think it was a Canadian fund, bought ABP outright, the Associated British Ports. And I think in that year, that was more investment by that one fund in that one deal than the entire infrastructure investment by DC pensions in the UK in the same period. So ultimately it boils down to scale. I think that the high level of investment in infrastructure projects and assets across the UK, whether it's airports or utilities, transport, by Australian, Canadian pension funds, by sovereign wealth funds, to me indicates that the demand is there. These are sophisticated investors who tend to require returns. And again, it points me towards thinking that it's primarily a structural issue within the UK pensions industry that is the main barrier to more investment in those sorts of assets, because other sophisticated investors clearly are comfortable buying them.
I think there's another factor in this, which is a structural factor. Nobody disputes that scale is a real key to investing, particularly in some of these private markets. But investing in private markets requires significant additional resource internally. So when you look at schemes like USS, RailPen, some of the asset pools for LGPS, they have huge resources devoted internally to due diligence and governance of private markets. It's a very different type of investment than investing in listed assets. And many of the schemes in the UK are resourcing up to achieve, for example, what they've committed to under Mansion House Accord. But that takes time. It takes time to get the governance regimes in place, and it takes time to get the resources internally that can do the due diligence work and work with the managers. And I think it's a matter in the UK of transition. We're going through it. We've certainly heard in the research we've done recently a huge amount of appetite for investing in private markets and for investing in the UK, but signals that it will take time and it's not an overnight activity.
Thank you. David Pinty-Duchinsky.
Thank you, Chair, and thank you so much for taking the time to come and talk to us. Obviously, this is incredibly timely because just yesterday, obviously, we had the announcements of the Mansion House Accord building on the work of the Mansion House Compact a couple of years ago. And as you said, that's in the context of levels of investment into private markets and specifically into UK private markets that are much lower. I think that one of the quoted stats was that our DC funds invest about 4% versus up to 40% in the US for domestic equities, both and private markets. Obviously, the Accord's based on a voluntarist approach, as was the Compact before it. Do you think that will be effective?
I think it comes down to the comment that Jessie made about pipeline, and I think we've seen that as a caveat on the Accord, haven't we? That the real key, and I've heard it time and time again in discussions I've had recently, it's about having that very visible pipeline of opportunities for schemes to invest in, and it's about getting the structures right. Particularly, I've heard that discussions with local authorities, for example, local authorities are not as used to dealing with pension schemes as they are with banks, perhaps. So getting the structures right that work with pension schemes is part of the equation. But ultimately, it is about performance, of course, and so seeing the performance delivered as well will help. The fact is US equities have outperformed UK equities hugely over recent years, and that's a factor in particularly when we've seen a shift to passive global investment.
I think one thing that's really promising about this is that the government is taking a more activist approach and has even threatened mandation as a tool to get the industry to invest more. And I think that's welcome, because I think for too long we've had this assumption that the only purpose of the pension system is the returns that savers get on their savings. But actually, when you think about it, for pension savers, it matters, your returns you get. How the economy does matters a lot to you, because it affects your employment prospects, and therefore that's the biggest impact on your likely retirement outcomes. And how the environment does matters an awful lot, given the fact that we're heading towards very significant financial and economic losses caused by climate change and nature destruction. So it's right that the government should take a broader perspective than just a system that delivers good returns for savers. It also needs to work for the economy and the environment. And so part of that will be pushing the pension funds to do more of the investment that's good for the economy and the environment, and part of that will be helping them to do that. And there's two elements there, of course. The first is the industrial strategy, which we're awaiting, and that will need to be effective and put in place the sensible way of supporting investment into key priorities. And the second, as I've said, is the National Wealth Fund, which will need to scale up dramatically if we're going to get the kinds of scale up of investment that we need, particularly to meet our climate commitments.
I think the real value of the Mansion House Accord, the Mansion House Compact from a couple of years ago, is that it is keeping the conversation going around the different options for pension funds and the potential benefits to them, to their members, and to the wider economy around investing in a wider range of assets. A lot of the industry, and it seems to sort of default, no pun intended, into a fairly vanilla, straightforward, low-cost asset allocation, partially structure, partially culture, habit, incentives. And I think it's just really important that government and other actors have sort of come together to keep this on the agenda and keep the conversation going. And I think it's also really important to not view it in isolation, but in the context of all of the other reforms going on. It's less likely to succeed unless we see more consolidation in DC, and probably we may need more accelerated consolidation in LGPS and other reforms around the value for money framework and so on.
Well, and that's what I was going to ask, and then I'll hand over. But I suppose I'm hearing it's necessary, but what else is sufficient? To take the example of private markets, we know that 80% of the delta in UK market, in kind of UK equity issuance in the last year, well, not equity, but private equity issuance has been private rather than public markets, and yet, so that's been the explosive growth, and yet there's been a real reluctance to invest in them. For instance, I realise there are also regulatory things. Are there any other measures? Aside consolidation, you mentioned the value for money framework that we'll come back to later, I'm sure, that would go with this to help make this a success. Can I reflect on that and come back to you? I'd be very happy to. I'm sure there are, and just none are coming immediately to mind.
So the one thing we hear a lot of is the planning system being a barrier to some investments. So planning is what comes up in discussions. And then, of course, there are those who advocate for fiscal incentives for investing in the UK, and that's a whole other bag of issues that has complexity around it.
Most definitely. Thank you.
I mean, I think it's, as we've said, there's a lot of issues on the the industrial strategy side, and is it, do we have the pipeline of assets, and is it easy as it would need to be for pension funds to do that? I think we've talked about the scale. I think the nature of the fund matters a lot, and the more we can have either a revival of DB schemes if we increase contributions, or move to collective schemes that have a longer term horizon and are trying to deliver a higher return, and therefore will be more interested in a wider range of assets. I think that's also important as well as the other things that people have mentioned.
Thank you so much. Thank you, Chair.
Thank you. John Milne.
Thank you, Chair. It's always been a very high principle that under fiduciary duty that the pension funds must act in the best interest of savers. On the face of it, mandation is a potential conflict with that, or contradiction with that. How would you react to that challenge? Perhaps William, if you start.
Best interests of members under fiduciary duty is a term that would include many other decisions taken by pension funds, their investment committees and their trustees, not just their asset allocation and investment decisions. Whether or not they adopt a passive or an active strategy, whether or not they're going to even consider going into generally higher cost private market assets, which managers they choose to run their money, most importantly perhaps for smaller schemes, whether they should even continue to exist in their independent form, or whether they should think about folding themselves into a much bigger, more efficient scheme. Part of the challenge, when you ask, and we looked at this with LGPS across 86 schemes, if you ask 86 different schemes in the context of their fiduciary duty to invest in the best interests of their members, you will get 86 very different answers. In UK equities, it ranged from 1%, just under 1% of total assets in UK listed equities, to just over 30%. In private markets, 0 to 25. So I struggle a little with the fiduciary duty argument, because there is so much variability already in so many other factors that have an impact on fiduciary duty.
Very interesting, thank you.
I think maybe it's worth, I agree with everything that's been said, I think it's worth first of all saying that whilst the fiduciary duty should be paramount for the schemes, the government has a different and a broader mandate, and needs to look at the collective interest of all pension savers as a whole, which are not the same necessarily as the financial, always aligned to just getting higher financial returns for the schemes. And in particular, when you think about the deep inequality that's embedded in the system, so the ONS estimates that the bottom half of the population holds just 1% of all pension assets, and the top 10% holds almost 2/3. So if you just focus on growing the financial returns, most people are not going to benefit from that. And so a system that also supports a stronger economy and the green transition would actually benefit, I would argue, most people more than a system that focuses on higher returns. Having said that, I don't think there's necessarily any contradiction in fiduciary duty, because we know that fiduciary duty does allow for considering impacts on the community, on the environment, on the economy, and also the views of members, which have been shown many times to be strongly, for example, in favour of more sustainable investment. And I think the main issue is it's interpreted quite broadly, and so we do need to clarify it. And so I know Share Action, for example, are proposing amendments to the bill to do that, or some way that we could have a more consistent definition that recognised that broader issue would be helpful, I think.
So I think it's clear there's no appetite amongst trustees and providers at the moment for mandation, and there's an interest in driving things voluntarily. And I'd agree with everything that's been said there. What trustees in particular value is clarity around the rules that apply to them. If there were mandation, then that would clearly override some of the issues of fiduciary duty. So what would be necessary then would be for clarity around the guardrails that would exist for mandation into UK assets, to ensure that there wasn't the compromise on members' interests to any excess, and some guidance from regulator about how to apply that. But I'd come back to there not being an appetite at the moment amongst any of the stakeholders.
I think you've partially touched on this already, but do you think it would be helpful to have some more formal definition of what fiduciary duty consists of? Clearly, it's being interpreted very widely already from what you said, William. But would that be beneficial to give clarity to the industry?
Absolutely, yes. I mean, there's two different ways. One is in terms of the guidance, and the other is in terms of clarifying the law. And I think there's a reasonable amount of consensus that we do need better clarity. And I think I would support the share action proposals to use the pensions bill to gain that, or if you can't do it through the pensions bill, then you would need to do it through other mechanisms.
I've not done a huge amount of fiduciary duty research recently, but I think one thing that I've observed, and I think the committee's heard on this before, is that trustees are generally satisfied with the review from the Financial Markets Law Commission that took place recently, and that's come up in a few conversations. So maybe coming back to that, some of that would be helpful.
Thank you. David Pinto.
Thank you so much, Chair. And look, this is obviously, and thank you for your comments. This is obviously a very fraught issue. I did want to come back to something Jackie said. You mentioned that there's kind of uniform opposition within the sector. I suppose conversations I've had suggest it's a bit more nuanced than that. It depends which bit of the sector. You said asset managers are utterly opposed. Some of the larger companies, especially those with already, deeper asset investments in the UK, are actually relatively relaxed, and then there's a kind of spectrum, of master trusts and stuff in kind of between. I suppose my question was, isn't this also slightly chicken and egg? So that if I look at, say, the US, there's huge domestic investment, which drives higher returns. And if the argument is, this is fundamentally an argument about two things: returns and what the duties are on trustees, and how they avoid, having low performance and then having an FCA investigation a decade later. But on the low returns thing, isn't one of the key things to actually drive up levels of UK investment, get that investable pipeline going? Because that will actually drive up UK returns, to Jesse's point, which will help kind of dissolve this problem.
Yes. I mean, but it works both ways, I think. One is having that pipeline of investable opportunities that deliver the right kinds of risk return that pension funds in this case are looking for, or other investors are looking for, and that's why I think an industrial strategy approach is the right one. But of course it's not easy to do an effective industrial strategy, and so we'll need to see what the details of that are. But it is also true that the availability of capital is important, and so I think encouraging pension funds to do more investment in the UK voluntarily initially will help too, because the pipeline of investable assets is not just out there, it also depends upon the financial institutions to help develop those. And in particular, that's why I would argue that the National Wealth Fund has been the missing part of the infrastructure in the UK, a national development bank that both helps to aggregate capital, so co-invest with private investors, including pension funds, but also to actively go out there and build that pipeline of investable assets, create the deals that people need in order to do the investment. So I think that's one of the key things that we've been sorely missing in the UK, and hopefully if we could really scale up the National Wealth Fund, that would really help the whole ecosystem do better investment.
If I may, on the chicken and egg analogy, there is a sort of fundamental structural issue going on here in UK listed equities, that because the UK started with a bigger, more developed pension system, which had a higher allocation to UK equities, over the past couple of decades, there has been this shift which has accelerated from moving from this sort of UK-centric approach, maybe having 30, 40, even 50% of your assets in UK equities, to a global market-weighted approach, where, given the UK's weight, you're likely to have 3 or 4% of your equities allocation in UK. And that may have been in the individual interests of each pension scheme who made that switch. But as the collective impact of lots of large schemes making that switch over the past 10, 20 years has sucked an awful lot of natural demand, if you will, out of the UK equity market. It's helped, there are lots of other factors, but it has helped keep returns lower than they have been historically, which starts to create this sort of doom loop of lower demand, lower valuation, lower interest, lower weighting, and back round you go.
Exactly right. But I suppose that also flags up the extent to which, because our funds have been very heavily focused on public markets rather than private ones as well, you get into that doom loop pretty quickly, and then as kind of IPOs and stuff drop off a cliff, I think there were only 18 IPOs in the UK last year. Yeah. You then get in, as you say, to that doom loop. So it's and do you think consolidation will? And so clearly there's something about getting a pipeline going. Clearly there's something about encouraging people to shift towards private markets. We talked a bit about the role of mandation, and this is a voluntarist approach, although I know the FT had a story yesterday suggesting there might be a reserve power to mandate if stuff wasn't met. What role does consolidation play in also driving not just better investment, but better investment specifically into the UK?
Into the UK broadly,
public and private.
On the public equity market side, actually the lessons from consolidation is that it could actually accelerate this shift to reducing allocations to domestic equities. We've seen that in Canada and the Netherlands, which are two of the examples where they have highly consolidated systems. They are the only two pension systems that, on virtually every count, have a lower allocation to domestic equities than UK pensions do. On the private market side, consolidation in and of itself is not enough to deliver more investment in private markets, in unlisted equity and infrastructure. You need capacity and skill that go alongside that. That takes time. But I do think consolidation is a requirement. It's a threshold capacity. If we don't have it, then I don't think we're going to see significant increase in investment in these assets in the round or investment in these assets in the UK.
I agree. Scale is critical for private markets particularly, and therefore for UK private markets. But it's important to recognise, I think, that we already have quite a lot of consolidation in DC. So we have only 20 real players in workplace DC, if you exclude the single employer trusts, put them to one side. And around 7 of them have DC assets of more than 40 billion each, and control about 80% of DC assets. So you've already got quite concentration in that part of the market. So the question then is, why is that not acting adequately to drive more UK and private market investments? And you've got some underlying structural issues within there. The proposals to allow bulk transfer of contract-based members into other schemes, perhaps into master trusts, might help with some of that. Particularly where a provider manages both contract-based and trust-based arrangements. So it's a fairly simple transition for them to move everyone into the trust, well, hopefully into the trust-based. So there are things that could be in the bill that might help that. And limiting the number of default arrangements might also be something that could help, but I've not investigated that in huge detail. But there are many default arrangements within an individual provider, partly because large employers like to run their own default with their own advisors, which is a legacy of them having run their own trust-based arrangements in the past and moving into master trust. So there's maybe some other structural issues that maybe you come back to in other discussions.
I mean, I agree. I think, as you said, consolidation is a kind of necessary but not sufficient condition. And I think the basic issue is that largely now asset managers are very dominant in the UK system, and they're not looking to do sophisticated investment strategies. And so we do need to have larger more competent, professionalised funds that would be able to take a lot of that responsibility themselves. But I think it also matters what types of funds they are and what promises they make to their members. And I think that's another key part of it, is that we want to have funds that are focused on delivering high returns for members. And that means ones that have more collective and less individual promises. And I think there's also some evidence that whether they're for-profit or not-for-profit can matter. So I know there was a study in Australia showing that not-for-profit funds invested 18% of their portfolios in unlisted assets, whereas for-profit only 4%, and that's partly because they were more focused on delivering a higher return for their members. So there's quite a few different things, I think, that would contribute to a shift in the system, and all of that would need to sit alongside, as we've discussed, the real economy actually changing and the government's industrial strategy creating the investments to invest in, and the National Wealth Fund providing better vehicles for that.
Thank you. I mean, one other, and I'm conscious of time, issue that kind of goes with that is some of the value for money framework. And I've got a separate question that I'd love to pick up, but I don't think we'll have time, about at what level consolidation happens. You talked about companies. Is it company level, at master trust level? Where does consolidation actually occur? But the other thing that you hear a lot is the value for money framework, and people being told that, for instance, we are always ranked purely on our cost base rather than on returns, outturns, impact. Do you agree with that, and what would you like to see change in that framework to help unleash some of the stuff you've talked about?
I'll pick that first. So I think we have to separate out a number of things here. So when trustees and IGCs look at value for money, they are not just looking at cost. But the way the market works is that employers and their advisors very often focus on cost. So that's what drives the selection of schemes, and it drives schemes and the providers to seek to bring their prices down and to compete on price in part. The value for money framework, if it shifts the focus, and it has to shift the focus of employers and advisors primarily towards net returns being the key discriminator, then that will change. That will change the dynamics in the marketplace. There is, alongside that, a worry, of course, that what it will also do is move everyone, the reversion to mean idea, that everyone replicates everyone's investment strategies because nobody wants to be an outlier, and that's claimed to have happened in Australia. And whether that then leads to greater investment in the UK, I think it's hard to join the dots up at that point. But it comes back to the things we talked about earlier about opportunities.
Thank you.
I agree with that. I think it's about the focus on the net returns, and then recognising that the other issues that I've mentioned also link into that. The promise you make to your members affects the kind of return you're aiming for. I think the nature of you as a fund and your capacity to do that also affects it. So I don't think I have anything specific to add.
Yeah, brilliant. Fantastic. Thank you so much. Thank you, Chair.
Thank you. And that concludes our questions for this panel. Thank you so much for coming along today. It's been a really, really interesting session. That concludes this first panel. Order. Take Order, and a very warm welcome to our second panel to this one-off session on the investment in the UK economy and the pension scheme bill. And we have with us today Rachel Croft, Chris Curry, Joe Dabrowski and Yvonne Braun. I wonder if you'd be kind enough to introduce yourselves and the organisations you represent, starting from that end, if that's okay.
Thank you, Chair. My name is Rachel Croft. I'm the Chair of the Association of Professional Pension Trustees, the APPT. We act as the collective voice for those individuals who fall under the definition of professional trustee as set out in the Pensions Regulator's policy document of August 2017. Our members act as trustees of DB, defined benefit, DC, defined contribution schemes, including DC master trusts, and together we govern collectively around 1.2 trillion of pension scheme assets. Thank you.
Good morning, Chair. My name is Chris Curry. I am Director of the Pensions Policy Institute. We are an independent research organisation with a remit to provide an evidence base across all pensions and retirement income areas.
Good morning, I'm Joe Dabrowski. I'm the Deputy Director of Policy and Regulation at the Pensions and Lifetime Savings Association, a 101-year-old trade association representing pensions schemes and providers. We look after, our members look after over 30 million savers and over $1 trillion worth of assets.
Good morning, I'm Yvonne. I'm Director of Policy for Long-Term Savings, Health and Protection at the ABI. We're only 40 years old, but we are the voice of insurance and savings for the UK. So represent the big insurers, the big master trusts, very similar to the PLSA.
Thank you so much. And we've all got some questions for you, but I'll kick off if I could. So a key aim of the bill, as you know, is to drive consolidation and scale in the pensions market. But what role do you think that the government has to play in this, and particularly to encourage defined contribution schemes to consolidate? It was interesting to listen to the first panel. I think you heard them saying that that's already happening now. So what more do you think that the government should be doing?
I'm very happy to maybe start on this. And very helpfully, there were some new figures out yesterday from Corporate Advisor. And it is true, there's already a lot of consolidation in the UK market. The biggest 12 UK master trusts and insurers together have 95% of the assets. That's actually better than in Australia, where the 25 largest have 96.3% of the assets. So it's a great deal better. But nevertheless, we fully endorse the drive for scale and consolidation of the government. It's really, really important for all of the reasons that the previous panel have already set out. And the reforms that government are taking forward, particularly around value for money, and also the contractual override, which I want to come back to, is super, super important, will really help with that. And I'll just maybe briefly say why. The contractual override is very important for the contract-based schemes, and often that's not much talked about because it's all about master trusts, but that's a huge part of the market and will remain a huge part of the market, getting about half of the inflows, so about 6.3 billion or 6.4 billion, and the other side gets 6.3 billion. It's about roughly the same. But what happens there is that these are individual contracts with the customer, with the saver. And so if a provider wants to move a saver to a more modern fund, they can't do that without getting that person's individual consent and say so. And as we all know, engagement is pretty low in pensions. So this contractual override, always in the best interest of the customer, is really, really important for consolidation, almost, if you like, inside providers. Mm-hmm. And the value for money reforms are also incredibly important because, and it's already been said by both William Wright and Jackie Wells earlier, there is a huge focus, I dare say an obsession, with keeping things as a low cost as possible and using that as the yardstick when choosing a pension scheme. And that's a huge problem for this industry because we are really only the supply side. But we also need changes in the demand side. And we hope that the value for money reforms will drive some of that because it will be much easier to compare schemes. And also, it will focus on long-term value rather than merely on cost, cost is important. But that's not the most important thing. Actually, the net returns are more important still.
got some questions on value for money in a moment. But Joe, what do you think?
I think as Yvonne on the previous panel said, consolidation in the DC sector is actually quite a long-term trend. There's been a 40% reduction in the number of DC schemes in the system over the last 5 years. I think some data dropped yesterday or today from the pensions regulator saying that been a 15% decline in the number of DC schemes in the system just last year. So this is a kind of a thread that's been happening and a push in the market, in part also following the authorisation regime for master trusts. In the bill itself, on the face of the bill at the moment, we have the value for money regime, which will be supported by the FCA and DVP and TPR's consultations thereafter. What we also expect from the response from the Mansion House consultations is the introduction potentially of scale tests in the master trust space, in particular with a look to try and drive some of that scale by 2030. We should hear about the kind of detail of that over the next couple of weeks, and I think that will probably make its way through to the bill. Those things will push this consolidation agenda further and faster. Overall, I think the kind of benefits of consolidation are kind of well known and well rehearsed, the ability to kind of generate economies of scale, diversity of investment performance, and also provide better or different services to members as you kind of get scale. There are some questions still to be answered, I think, in terms of how do you make sure that the system continues to have innovators and new entrants. If you get to scale, we don't want to end up in a market that is very narrow, and then you lose some of that competitiveness, and you see that in other sectors of the economy where you have very few providers, and innovation and customer service has not been at the kind of forefront of progress. So I think we're going to see those elements. And I think overall we're supportive of that general direction, but there's a lot of nuance that needs to be considered.
Thank you, Chris. I'm just conscious and thinking about the any additional points that the government can make on this, their role around that.
Yeah. So really, I think in that context, just an observation. I think more than anything else. So clearly, consolidation has been either implicit or explicit in much of the policy that's happened over the past 10 years or so. But even comparing to other markets, I think we have to be careful not to just assume that consolidation is automatically scale. Because I think the differences between the UK market, for example, and the Australian market is we're talking about consolidation in a part of the UK market. The UK market is still fragmented. It's not just trust-based DC. There is still contract-based DC. Now, some of those things, putting those together might be another way to consolidate and get scale. But then we've still got defined benefit private sector, defined benefit public sector, as we heard in the last panel. Those are all large. So when we're talking about comparing with what happens overseas, they generally have much less fragmentation and a much more singular market that they're talking about. So consolidation is important, but I think the focus for the government at the moment is much more on scale rather than necessarily just consolidation.
Points. Thank you, Rachel.
And thank you, Chair. And just to add briefly to the comments already made by other panellists, it's clear that consolidation is a trend that's been in place for some time and looks set to continue. On the scale point, we can of course see the argument for scale, but I think it's important to note that scale of itself doesn't necessarily guarantee better returns for members. And there are plenty of smaller master trusts, for example, delivering good returns, and own trust DC schemes also delivering good returns. Thank you.
Thank you. Thanks so much. I'm going to hand over now to David Pintachinsky.
Thank you so much, Chair, and thank you all for taking the time to come talk to us. I'd like to return to this issue of value for money. Lots of interesting conversations about scale, not least around, as we said, what level consolidation should happen at. But value for money seems to be a key driver. And as we heard in the previous session, whereas the framework allows for a kind of multitude of factors to be factored in, the reality is that it's very cost-driven. And that we've talked about things like Australia with their league tables, but then you have the risk of convergence. So there's kind of lots to unpack there. Firstly, do you think the industry is actually equipped to implement the value for money framework?
Thank you very much. Good question. And I think it's inevitable that, since 2021, schemes with 100 million of assets and less have had to do a form of value for money framework. It looks as if the new requirements that are likely to be in the pensions bill will add quite an onerous new set of requirements on schemes with multiple new data points. Therefore taking time to carry out that exercise, and that is likely to achieve further the consolidation in and of itself.
So value for money, again, a bit like consolidation, is something which has been on the agenda for most pension schemes for quite a long time. And I think at the PPR we've done some research looking at international comparisons of what happens in other countries and what works and what doesn't work, and obviously with international comparisons it's very difficult because each system has its own unique features. The cultures are different, the kind of politics around things are different as well. But there are a number of key things that came through that are really important. I think there's always a tendency for whatever is measured gets the attention, and I think we have to be very careful that we don't just set up something which on the face of it is quite onerous, all of it looking at things which are probably worth looking at, but in a way that actually doesn't actually change behaviours, just leads to more transparency in some things in doing that. So transparency is really important in in what you do for value for money, because it's only really helpful if people can actually make any decisions or take action based on value for money. Now at the moment that means that it's generally cost, because that's the only thing that's really transparent. It's easier to understand even if it doesn't give you the full picture on value for money. So I think while the framework is really helpful in starting to broaden that discussion out into different things, that it's not just about cost, actually the real test is going to be, can you take that information and make it something which is easy to present and easy to understand? And I think this is where we're going to struggle, because each different pension scheme and across the different sectors all have different advantages and disadvantages, and so being able to say that this is a good pension scheme in terms of value for money, but this isn't such a good one, may well depend on what you're looking at as part of that. Net returns is obviously another one which has come up in international experience as being very important, but one of the challenges always there is over what time period you're measuring those net returns. And I think again, when we're looking at some of the discussions we're having around scale and consolidation, in investment in private markets especially, you may not see, if you're measuring over 1 year or 3 years, that you're getting the right outcome compared to others. But if you then looked over a 10 to 15 year period, and we're looking at very long time horizons for investing here for pension schemes, it's really hard to factor that in to how you're looking at what you're doing. So I think looking at all these things is really important, but the real challenge is how you weight them and how you present them and how you can get people to then understand what it is that you're trying to tell them.
I think it'll partly depend on how practical the final proposals are. I'm confident wherever we end up, the industry will be able to kind of meet the challenge, but where we are in terms of kind of process is we are expect to see the kind of headline limbs in the bill and more detail from the FCA and TPR on the specific consultation proposals. There was a lot in the last consultation from the FCA and TPR. They've engaged really positively with the industry over the last couple of months. So I think we're going to end up with a further set of proposals that should be streamlined and much more kind of practical and implementable. But the previous one may have led to some of the largest providers having to provide thousands of data points, which is just of no use to the regulator to read. Nobody's going to do anything with it, and it doesn't help savers. I think there's also an important point to think about: where does this value for money framework make a difference? The consolidation and the other high standards at the top end of the industry are likely to mean the impact of value for money is going to be reasonably limited in that space. Those are good providers, they've got high standards, there's an authorisation regime and the rest of it. Where value for money will probably make the biggest difference and where the regulatory focus should be is on that smaller end of the market, where we know already that the engagement with the value for member assessments from TPR has been fairly modest, to put it generously, and that's where value for money can probably have the biggest impact in terms of making sure that everybody gets a good performing scheme at the highest standards, and I think that's where we'd like to see some of the focus shift a little bit.
Yvonne.
I would equally have no doubt that providers and schemes are able to implement the value for money framework, but it is really important that it is practical and that it is focused on what is most important here, which is this point about giving the supply side the ability to compare schemes appropriately, and that it captures particularly net returns. And as Chris said, it will be very, very important to decide just exactly what do you present, how do you weight it, etc. But we're fairly confident, much like what Joe just said, that the regulators are listening. And the general point that I'd also like to make in this context is also really important that the cost-benefit analysis is borne in mind here, because we have often observed, particularly with also the FCA, that the cost is often underplayed in their assessments. So that would be very important too, that actually the cost of the scheme justify the benefits that we're expecting.
I suppose just one final question that's very helpful, and it sounds like it will, at the bottom end, drive a bit of consolidation through its cost impact, but you're absolutely right about getting the cost benefit right. I suppose I wanted to come back to your point, Chris, because obviously it's about then how market actors then use this information to kind of drive their own behaviour. You said it was difficult. I suppose I just wanted to ask a follow-up question, because it seems like other countries have cracked it, and of course each system has its strengths and the kind of behaviours it creates. But if I look at, say, Australia, and if I understand their system correctly, there's a league table, and if you're bottom for 2 years in a row, you have to write out to your members explaining why. I mean, that you know, obviously there'll be detail, but wouldn't a system like that help? Because also, you know, if we're trying to get away from something based purely on cost towards something based much more on returns and long and medium-term performance, wouldn't something like that be useful?
I mean, it can do, but it depends what your objective is. And I think in the Australian system, I think one of the key objectives, because there's lots of similarities in the super funds, because it is a super fund market. Was trying, as I think was alluded to in the previous panel, there was quite a big disparity in returns coming through from those which were run not-for-profit and those which are retail. And there was kind of systematic differences there. I think what they've tried to do is to remove that volatility, and actually what they're doing is making the returns all much more consistent across all the different providers. So that is a positive outcome. That's one thing you could do. But it does mean, as I was pointing out, one of the challenges is if you are taking a long-term investment strategy which might be different or contra to those which are taken in the market, you can find yourself at the bottom of the league table for short periods of time, 2-3 years even if longer term that would have produced a better outcome for your members. So trying to understand how important that is compared to any other factors you want to do is really important in making sure you're doing that. If I can give 2 examples of where something would be really helpful, I think one is in the current employer market, where through the automatic enrolment, it is the employer that chooses the scheme that individuals are enrolled into. As we heard, and as there's plenty of evidence, that's generally based on cost. And actually, if we could have a value for money replacing cost, that would probably give better outcomes for members in that. The other one is with a different hat. I'm working on the Pensions Dashboards programme. In future iterations of Pensions Dashboards, if you could have a value for money indicator, that might be very helpful in helping people determine what they might want to do going forward as well. So it's a bit like the kind of the simplicity of the outcome in Australia, but just making sure we're covering all of the different factors that we think in the UK market are important.
Definitely, although that presumably is relatively easy to design. Even a league table that says here's your return over 1 year, 5 years, 10 years, right? And then people can adjust their risk appetite, you know, pick on the basis of their risk appetite.
It's easy to design. It can be harder to interpret, and I think that's where the challenge lies.
Fair enough. Thank you so much. Thank you, Chair.
Thank you. John Mill.
Thank you, Chair. This has turned into a bit of a topical question, but do you think that pension funds are able to invest effectively into the UK market, and in particular the Mansion House Accord yesterday, whether you think that will have a positive or negative effect on that particular issue? Rachel, if you want to kick off.
Thank you. So as trustees, our primary duty is to focus on achieving the best possible member outcomes. And so when looking at investment decision making, we will look at what investments in front of us are likely to give the best risk-managed returns for our members, taking into account the appropriate levels of liquidity for the individual schemes in question. So Forcing us to invest in the UK solely may run counter to that, unless, of course, there is a pipeline of suitable investments that are in a format suitable for pension schemes to invest in. And if that is the case, then we will invest in them. If not, then our primary duty will make us look elsewhere. We would welcome the Mansion House Accord reached yesterday, and again, we would suggest that with a suitable pipeline, and the Chancellor referred to the need for government to develop that pipeline of suitable investments for pension schemes, then we can see that working very well.
I'll keep it relatively brief because I know that Joe and Yvonne will have plenty to say on this, and we heard quite a bit in the previous panel. But for me, I think what's really important is how the discussion that's happening at the moment is changing the parameters around pension scheme investment. And I think what the challenge has been historically, as we've heard previously, about either scale being a barrier or there being other barriers for access to markets for organisations. And so it's actually not been in their interests, especially with the focus on cost, for example, to be looking to invest in those kind of private markets. And for the reasons that William mentioned earlier, the challenges around UK compared to global returns, with the focus purely on returns, has meant that there's been that shift to global investment. I think what we're seeing now is a recognition that there can be more benefit from investment. It has to work still in the interest of members. As part of that's really important. But if what we're doing is removing the barriers and making it easier to invest in that, and at the same time providing more of a pipeline for investment and trying to package it so it works well with how the pension system can operate, then you're creating that opportunity. And I think what's really important about the Mansion House Accord is that commitment to explore that opportunity and to make sure that there's an opportunity there which can not only represent the best interests of members, but also broaden that out. And I think there's been lots of really good discussion about fiduciary duty recently and about what that requires. And I think a broadening of that, kind of an understanding of the broadening of that and how it has changed, because it has been changing over the past few decades anyway, with long-term investing, climate investment, ESG is already starting to impact on the fiduciary duty elements. This I see as a further extension of that.
Thanks. I'd agree with Chris's point that kind of fiduciary duty is to some degree a kind of a living thing, and it kind of grows and changes over time with a variety of things. But in its current form, and it works well to ensure savers' interests are protected, and there are no obstacles to pension funds investing in the UK as part of fiduciary duty. We've heard some of the stats earlier, but pension funds invest about $1 trillion of the assets that they manage, of the $3 trillion into the UK in a variety of forms. We need to recognise that they're not homogenous, as I think William and others said on the previous panel, so the needs are different, and I think we are a little bit in some of that transition phase that we talked about in the first panel around the kind of shift from DB into DC and into DC scale, and also the shift in the LGPS from the funds to the pools and to greater scale in the LGPS has been happening over the last 5 to 10 years. So we're in a kind of significant moment of change. There is, I think, a recognition from schemes that investing in the UK has broader societal benefits where those investments are good and offer value for money. And, we think that's a really positive thing. And that's partly getting into some of those supply type questions. We think working voluntarily is probably the best starting point. There's been a lot of initiative over the last few years to remove some of the barriers, whether that's introduction of LTAFs, changes to the way that the DC charge cap operates and works. But we're really pleased with the Accord. We've had really constructive, positive discussions with government, with industry, a lot across the last many months, and I'm really kind of confident that we will make this a success. The parties that have signed up are committed to trying to deliver those objectives that we set out yesterday, and we think that really constructive engagement with government to support pension funds and insurers to get there is going to be really, really crucial over the next 5 years.
I'd echo that. We've worked with City of London Corporation and colleagues of the PLSA to galvanise members to orchestrate the Accord. So we're absolutely delighted with where we landed yesterday. And just to recap, like the key points here. Like 17 providers will invest 10% of their default funds into private markets, 5%, so half of that in the UK. And we think this is really, really exciting because it will be investment in growing businesses, it will be investment in major infrastructure projects, in clean energy, it will be investment in affordable housing and retirement homes and science parks here in the UK. So we think this is really important. By 2030, subject to the fiduciary duty and the consumer duty for the FCA regulated providers, as Joe said. And what we also said in the Accord is that it's very important that government puts in place the enablers that are critical to deliver this. We called out in the Accord particularly the value for money framework and the contractual override that I spoke about earlier. And of course a pipeline of investments. And we believe that the long-term strategy that government are putting in place around infrastructure, around planning reform, will make all of that much more feasible. So we're very, very excited about it, and we think it's going to be good for the country and for savers.
Thank you. And Yvonne, I think you partially answered my next question, was whether you think it's doable by the 2030 deadline, or target, should we say? Would everyone agree that it's feasible? Rachel, you were talking about need for a pipeline being made available.
I see no immediate reason why it wouldn't be possible. If I could just use the opportunity to come back on what one of the other panellists mentioned around fiduciary duty having changed over recent years. Subtle but important difference. I think fiduciary duty itself has remained the same, but the factors that trustees must take into account in what can be very complex decision making, those have moved on as the world has moved on. So, for example, when pension schemes were first put into place, I'm sure not very many people thought about climate change and climate risk, and now they clearly do, because it is one element of financial risk that could prevent members from receiving their benefits. So just a subtle but important difference, I think. To your original question, yes, I see no immediate reason why the target of 2030 couldn't be achieved. I think there's a lot of enthusiasm and energy in the industry at the moment on this topic, and I think generally as professionals working in the UK, we would want to engage and help with that as much as we possibly could.
Thank you. From the sound of it, it was an amicable agreement, an amicable accord.
Indeed, it was.
So it sounds like there were the threats were not necessary. Threats of mandation were not necessary. It sounds like we ended up in a happy place. And if the government were to then subsequently include powers to mandate in the bill, how would you feel, Yvonne? If you...
It's not desirable.
Yeah.
I think where we really want to get to is that for pension providers to, if you like, overweight the UK component in their default fund is a rational choice. That the UK is an attractive environment for investing, and that's why providers put more of the default fund there than they would perhaps in terms of the geographical allocation, which is 4%, right, if you compare it to world markets in total. So we would always advocate for incentives and reasons to invest in the UK rather than a mandation. And I think the government is, in quite a similar space, if I may be so bold as to suggest that, because I think ultimately government themselves also, and the Chancellor yesterday spoke about the importance of long-term certainty for policy, for the policy environment, and for pension schemes in particular. And everything referred around planning reforms, infrastructure strategy, etc., points in that direction.
Sure.
I'd agree with most of what Yvonne said. I think it's a really complicated change to make if you want to introduce it, and I would obviously have to see if there was a proposal, the kind of details, specifics and the guardrails, as the term that Jackie used earlier. I think there are kind of three things I'd call out as kind of maybe threads of things to think about. Kind of that question of how do you overcome the supply issue. You need that strong pipeline of investable assets. So if you don't have that and you have mandation, or you have a scheme competing against each other for the same assets, and that risks asset bubbles and also poor value for money. There are a number of kind of incentives that we think would work in a better way, which we've set out, and happy to share the reports with the committee that we've produced on that. I think it's a really important question of trust. Trust in the pension system is sometimes fragile, and I think the risk that people perceive government interference in their investments is a real one. Savers, when they're asked, generally support investing more in the UK, but they don't typically support the government directing that or being perceived to direct that in any way. I think, as we've heard earlier, most savers today are also saving in a DC environment. So it is savers that will carry the downside of any underperformance of an allocation that is perhaps suboptimal against its peers or competitors as an option. So I think that's a real thing to think about. And then I think there's the question of the kind of application of any power. How is it applied to protect savers' interest and also to protect fiduciary duty? And then there's a lot of really sort of fairly dull kind of practical questions that come with it. What is the definition of a UK investment? Like listing on the FTSE isn't necessarily, you might have a company that's listed here, but the majority of their operations are overseas, for example. Assets can be in complicated wrappers too. So I think, and then how does the regulation reflect the fact that markets might move? If you had a 5% portfolio today, 2 weeks' time it could be 4%. Does the regulator come and intervene and tell you, oh, wind up, or you're going to be fined, or something else? There's a lot of really nuanced, complicated stuff with this, which I think you'd need really solid answers to understand how that would work.
Thank you. Any bits to add? I think we're a bit pressed on time. So.
Just quickly, if that's okay. So first we heard from Jackie in the previous session about undertaking the PPI research. We've heard about the time it's likely to take with transition, to build this up is not going to be quick. So you can see why the government might want things to happen more quickly, and so look at mandation. But just on top of what we've already heard, I think there are a couple of things I would say. It can be very blunt. It can be very inflexible. And you have to watch out for unintended consequences. And I think all of those things are really important to understand before you start to head down that route.
And just very briefly, perhaps unsurprisingly as trustees, our focus is on seeking the best possible member outcomes. So we would be against any form of mandation that might prevent us from achieving that objective. And the risks of mandation have been set out already by the other panellists, I believe.
Thank you.
I'll just quickly follow up on that, Chris, in terms of possible unintended consequences. Would you like to name a couple?
Yeah, so I think it partly relates to what Joe was saying as well. So, for example, if you are having to have a certain proportion of assets in a type of your overall assets in a certain asset class. So firstly, that there's that definition, but secondly, there's market movements. And so we've seen recently, even in the early part of this year, some quite significant market movements, not necessarily here, but overseas, which will affect the overall size of your portfolio. Now, if you're working one way, it could increase your weighting in the mandated asset. If it works the other way, it can make it lower. A good example of this, potentially not identical, but where you had similar unintended consequences and maybe having to take the wrong type of action, was with the LDI issues that we had, where the people were forced to take actions. Now, it wasn't mandation in that sense, it was the type of product that they had, but you can see there's similarities.
Thank you so much. Damien Egan.
Thank you, Chair. I want to take us forward to retirement, and as part of the King's speech, the government announced measures to require pension schemes to offer default retirement solutions. Do you think default retirement solutions will improve outcomes for savers?
Shall I take that one first? So, in principle, I would hope that it would. It's a very complex decision for a member to make how to take their benefits at retirement, often across a number of different pension schemes at the current point. And anything that could help ease the complexity of that decision and the pressure of that decision is bound to be helpful, subject, of course, to the right design of the default, which, of course, is the $1 million question at the moment.
We'll come to that one.
So this is actually a very timely question because we're publishing research today sponsored by the pensions regulator looking at issues around default retirement solutions and what's happening currently in the marketplace. What's really interesting from that is that a kind of a significant proportion, somewhere between 2/3 and 3/4 of people are going through this process without having any guidance or advice or help in what they're doing. And in fact, what we're seeing is there are kind of almost two behavioural defaults which are coming through. One is people cashing in their pension, so taking money completely out of the system. The other is a kind of inadvertently going into drawdown because they're taking out their tax-free lump sum and leaving the rest invested, and so by default it goes into a drawdown solution. So people aren't making any active choices, or a lot of people aren't making active choices around what they do. So there's definitely scope for there to be a lot more help and a lot more support given to people in this situation. The challenge that the industry is facing around this at the moment is a lot of uncertainty as to what it is possible to offer under the current arrangements, and this is where the work that the FCA is doing on the guidance and advice boundary review is really important, and the targeted support ideas coming forward are really looking to get a bit more of an understanding of what this means. But the real challenge, I think, as Rachel has alluded to, is whereas when you're building up your money, a default is quite obvious. Everybody needs to put money into a pension. At the other end, when you're taking money out, it's actually not as always as clear cut as to what the right approach is. And generally, there isn't a single right approach. You probably want a combination of different things, and what you want might change over time as well. So it's really important that when we're looking at defaults, we're looking at ways which maybe they are tailored towards different groups rather than a single overall default. And it has to be something which is capable of being flexible and adapting as people change and their requirements change through their retirement. Yeah. A really obvious example here is bereavement. You want to make sure that it can cope with those kind of adjustments as well.
I agree with all the points that have been made so far. The guided retirement products proposal in the pension schemes book is very close to the guided retirement income choices framework that the PLSA developed and set out a couple of years ago. So you might expect us to say we are very supportive of the framework, and we are, and we think it's really important for a lot of the reasons that kind of Chris described. That we know that a lot of people are now kind of coming to retirement, certainly in a kind of DC context, and they are not taking support. They can't afford advice. They might use the money in pension service, but we think that potentially has some room for growth, and they might be supported by their employer, but that's a sort of mixed bag of provision. There's a lot of good support from people, but it isn't universal. So we think actually making sure that people, as they get to retirement, get defaulted, or trustees have an obligation to think about the product that their member might go into retirement, and then that product is suitable. There's a lot of thinking that needs to be done to think about the product design, and there's also a lot of innovation that's going on in the market presently around that. We think it's a really important step to change that kind of at-retirement outcome for people, because we don't want people making suboptimal decisions, taking the money, putting it in the bank at 0% interest, and then drawing down potentially too much too. There's a whole load of support that people need. I think it's a really important intervention.
I think default retirement solution is a little bit of a misnomer, because a choice is always necessary. It's not like automatic enrollment and being automatically enrolled into a savings pot. It is different because there's tax consequences. There always has to be an active choice by the saver, by the customer, and we shouldn't dismiss engagement and choice in favour of default. And default's obviously an important part of the system, but wherever there's choice and wherever there's flexibility, we think that's important that people have help through these decisions. Now, as you said, I think, Joe, advice is obviously great. Independent regulated financial advice is obviously great, but only 8% of people take it. Guidance from the Money and Pension Service is absolutely excellent, but will only take you so far, and that's why we're really excited about the work that Treasury and the FCA are doing on targeted support, which is a sort of a middle way, if you like, between a pure information guidance provision and the full regulated advice proposition. And I think it is really important that people get that support, because the circumstances, as I think you said, Chris, that people arrive at retirement can be so different, because their health circumstances can be so different, or their family circumstances, or also their dependents. What we think is really important is that the thinking in DWP about guided retirement solutions and the thinking in the FCA and the Treasury are joined up, because what's, I think, in terms of the current proposition from DWP not quite clear is where the guiding comes in. So it talks about a retirement solution. We can say, yeah, maybe it should be flex and then fix or whatever, but where's the guiding? So where's the element of help that people get? And we think that's really, really important to help people make the most of their retirement finances.
Do we have enough information on the outcomes of people who have gone through and sought advice once they get to retirement, and what their outcomes are versus those who make their own decisions? And like, are we able to say to people that those people who've got advice have performed, their retirement has performed this much better?
There are studies about generally the benefits of advice. I think the International Longevity Centre once said it adds another £40,000 to somebody's overall wealth, but I would have to check whether there's something specific, as you suggest, in terms of the actual. This is the sort of the cost benefit analysis, as you so to speak, for advice at retirement. But I would say in general that we do know that there are a lot of quite poor decisions being made in terms of people taking the money out, maybe in totality paying too much tax, or taking the money out, put it into a bank account, which is mad. It's just mad, because they think it's more tangible. I mean, it's all understandable, but we certainly know there's a fair few bad decisions being made.
It'd be interesting to know if there's particular demographics who are more at risk of going down an unguided route.
So interestingly, there was some research published earlier this week that Aviva and Age UK were looking at, which was looking at, it was all about non-advised, so it didn't really have that distinction between advised and non-advised. But there are some really key themes coming out from there as well, still about the lack of understanding of the risks that individuals are facing. So these were people who were kind of in the 75 age bracket, so they'd been, it's kind of looking that the idea is about a mid-retirement MOT, so some way to try and help people when they're already through that process, because what's clear is they're not just making a decision when they retire, there's a whole series of decisions which last all the way through their retirement that they need help with. They were really I think keen on the idea of some kind of support, and some of that was looking at, for example, the sorts of things that the Money and Pension Service already offer for people pre-retirement, might be the sort of thing they might like during retirement as well. They really didn't understand how long they might live for. They always underestimated the longevity risk associated. They didn't really understand investment and inflation. They wanted some certainty in their income, but they didn't want to buy an annuity. So there's all these things which we know, but what we do know is that people are tending to try and avoid making decisions as long as they possibly can, and sometimes that leads to them having suboptimal retirements up until the point they do make a decision, because they're either spending too quickly, so it means that they're struggling in later life, or they're not spending enough. And actually that could be just as important. People are actually having a lower standard of living than they could actually afford to have, because they're worried they're going to run out of money at some point. So getting some help to this group is going to be really important.
Can I just take us to the kind of exciting question, which is what a default retirement solution could look like?
And actually it segues nicely from what Chris was just saying, in that I think some emerging thinking is around there being three, and obviously every member is different. It's going to be, as Yvonne said, very difficult to design something that works for everybody. But broadly speaking, three elements look to be key. First of all, the ability to take, as many people already do now, an element of cash at retirement. Secondly, a form of guaranteed income to deal with day-to-day expenses and to provide sort of security of income. And that's typically going to be an annuity, but also could be a collective defined contribution, which is an emerging new option that could be put into place, which would manage longevity risk for an individual member. And thirdly, an element of drawdown, so that would be for the big items of expenditure, perhaps care later in life or to pass on.
I'd agree with Rachel's description. I think one point is probably worth making, that we're in the reason why it's also really important that this change happens now is because we're at probably a beginning of a switchover point where most people coming to retirement today or over the last 5 years have come with a mixture of final salary DB and DC. Over the next 5 to 10 years, more and more people will be coming purely with DC, and therefore the choices and support they might need to make are going to be very different.
That latter point is absolutely crucial, that we really need to resolve this, because it's going to become ever more important for people to make these decisions with their DC pods.
Thank you very much.
Just add one other thing, just to maybe burst the excitement a little bit. The challenge is, for providers, they only know what the individual they have with them. And we know that people at the moment have multiple pots when they get to retirement. And so actually trying to come up with a default where you think this might be all they have to live on, when actually they might have other pots elsewhere, other forms of saving, the role of the state pension, all of these things makes it difficult for it to be just done through the provider. The other real challenge that we don't often talk about in the retirement debate is about whether people own their own home or not. And there'll be an increasing number of people coming into retirement who will still be in the rented sector and increasingly in the private rented sector, and they will have a whole different set of requirements than those who are homeowners.
Indeed.
Thank you.
Thank you. Thanks so much. Frank McNally.
Thank you very much, Chair. Good morning, and thank you very much for joining us today and for providing us with the evidence that you have. You just touched there, Chris, on multiple pots, so I'm going to focus this series of questions on small pots and some of the challenges linked to small pots. Obviously, there has been a significant increase since auto-enrolment, and we know the challenges that's created. The PPI, I think, is estimated there are 20 million DC pots worth under £10,000 no longer being contributed to, and we know the expected growth in the number of small pots if we don't take some action, and I think we're all acutely aware of the £31 billion in assets that we have linked to I think 3 million lost pots at present. So it's a confusing and challenging landscape. So would you support the government's position and proposals to try and address this issue, and what do you think some of the difficulties will be when it comes to implementation?
I mean, I think certainly there is real potential to improve outcomes through consolidation of lost pots. Firstly, for a number of or small pots, sorry, and certainly for the reasons you've been saying, small pots are more likely to be lost. If people have a number of different pots, it's harder for them to find it. But it's also, there's an industry cost attached to this as well, and so administering those kind of 20 million relatively small pots, and 10,000 is actually quite large. I mean, there's a very large number of much smaller pots as well, where it's very uneconomic to actually manage and have to administer those pensions. So if we can make it more efficient for the providers to administer, then hopefully those savings can be passed on to the individuals, and if we're talking about value for money, then that all comes into it as well as part of that. The challenge is, because lost and small are often combined together, that there has to be a solution which doesn't rely on individuals actually doing it themselves into how it works. Now, as I mentioned earlier, working on the Pensions Dashboards programme, there is an element where individuals will be able to find that information, but it still relies on individuals taking that first step and going to a pensions dashboard, and even then deciding to take action after being there, which we know at the moment is probably 2 steps too many for many people to get there. So some automatic solution probably has a lot of potential to get to a better outcome much more quickly than pensions dashboards would. The challenge is it's very difficult. One of the big challenges we have on pensions dashboards is the quality of the data and being able to match individuals with their pensions when they give us their own digital identity when it's been verified. I think the big challenge for the industry is going to be how you can be absolutely certain that the pension pot you have in provider A belongs to the same person as they think they do in provider B, and to make sure that if any money is transferred, that it's done in such a way, the levels of certainty are going to have to be much higher than we have on the Pensions Dashboards programme, where we're just sharing information if you're actually moving money from one place to another. And I can testify to the difficulties of trying to build a big digital infrastructure in pension space at the moment.
There's been an incredible amount of work done to try and consider the small pots issue by DBP, with industry, with co-groups that ABI and PLSA and PASA have also led on a couple of years ago. Recognition of the difficulty with this is really kind of widespread, and the need to find a solution. We are supportive of the small pots default consolidator model that's being introduced in the bill. There's a lot more work to be done, as Chris said, on the technical solutions, how to learn lessons from the dashboard, and also how to make it ideally as light touch and digital as possible. We're working with DWP presently to kind of understand what that might look like. We think there'll be more work to come over different phases, but I think it will lead to better outcomes for savers ultimately, and a more efficient and more effective system. In terms of timing and practice, I think there's a lot of material that we talked about today. The sequencing of when some of the solutions come in will be really, really important. And I think we may have a few years before we kind of introduce the solution, because some of these other elements that are in the bill and some of the other elements around consolidation will probably need to come first in order to enable it to work most effectively and efficiently. And I think then we can take as many of the lessons from the dashboard that will have been up and running for a couple of years as possible into that.
I think there is a broad consensus that we would get positive outcomes for savers. Has there been any analysis done around what that might look like?
There's been some analysis done by DVP when they published their recent response. I'm happy to ping it through separately.
I would just add that we completely support the government's objective on this, because we need to help savers finding all of these small pots and consolidate them into one place. Matter of record that the small pots default consolidator was not our favourite policy solution for this, but we're now focused on getting the practical details right, and a number of our members, both on the contract and the trust-based side, are interested in becoming default consolidators. What I would say is, and you alluded to this already, Joe, this is a very significant tech build. Very, very significant. We know from, as Chris knows better than anyone, from the Dashboards project, that these things are pretty arduous, can take quite a number of years. So I think it's really important that with all of the reforms that we've been talking about today, that we think about how we can execute them in the most ordered, logical and efficient way. And if I can just suggest the order that we think is sensible at the ABI, we think we should start with the contractual override for the reasons I mentioned already. That will also, by the way, help with small consolidation and mega funds. Then we should go to the value for money assessments, because the contractual override will enable us to essentially get rid of not well-performing, not modern funds. So value for money assessment, then move to mega funds, and then move to small pots consolidation. And I think that way we'll make maximum use of the synergies that exist between all of these proposals, because we shouldn't forget the industry is also at the same time absorbing the dashboards, infrastructure, the tax support proposals, and the changes to pension inheritance tax.
Just some final comments that from a trustee and a member decision-making process basis, small pots is a difficult issue, because as a trustee looking at pots of even under £1,000, which are relatively common in many schemes, we have no visibility over what that member has elsewhere. So on one end of the spectrum, they could have a huge DB pot in another scheme, and on the other end of the spectrum, they could have little or nothing elsewhere. So it's very difficult to design an investment strategy and a retirement process on that basis. And if I put myself in a member's shoes, perhaps if I've got 5 pots of 10,000, I might be more tempted to take more cash than if I've got 1 pot of 50,000, where I might take some advice to how to manage it. So we're definitely supportive of a solution being found. And in line with the comments made by other members of the panel, there is a sequencing point here, I think, for government to consider. And certainly it would appear sensible, I think, for pensions dashboards to be implemented and well and truly up and running before a solution to smallpox can be found, because in some respects it starts to provide a little bit of the solution.
Thank you very much for that. If I can move on to talking about surplus extraction, and I'll maybe start with yourself, Rachel. The government's obviously outlined its position in this regard. What's your assessment from a trustee's perspective on the trustees having the powers that they would require to ensure that savers benefit if employers are able to more easily extract surpluses from DB pension schemes?
Thank you. I think the first very important point to make about DB scheme surplus is that a surplus is in some ways theoretical until either the last member dies in the scheme years and years and years in the future, or the scheme is bought out with an insurance company. Until then, we're only working on estimates of funding levels. So it's very important to bear that in mind, because, of course, there's an element of regret risk that could come to play should surplus be used while the scheme is ongoing, and then it subsequently transpires that there isn't enough to provide members with their full benefits. So that's the first, I think, very important point to make. I think, and then in terms of actual use of DB surplus, every scheme will have its individual rules on how surplus is to be used and who has the ability to determine that. Sometimes it's the trustees, sometimes it's the employer, and sometimes it's an element of both. So we're all in different circumstances. I think there are a number of factors that need to be considered jointly by trustees and sponsoring employers before surplus can be used, and the barrier should be set relatively high for the reasons that I've outlined. Those factors to consider include the scheme's ultimate long-term objective and timeframe, because actually the decision is not binary as to whether to run on in order to use surplus or to buy out, but more how long to run on for before eventually buying out, because I think most schemes will be on that journey eventually. Also, the ability of the sponsoring employer to continue to support the scheme post any use of surplus. The investment strategy, any buffer that should be there before surplus can be used, and then the arrangements, how to govern and monitor the arrangements that are in place. And I think another important point to make is that in some cases, trustees already have the power to determine use of surplus unilaterally without recourse to any other party. So any statutory override that's introduced should respect that and not undermine it.
Dale's got any thoughts on that?
I would just say that we at the PPR we haven't done any research on surplus extraction. All the work we've done on DB over the past 10 years has been how to make sure that we can pay the benefits that are due to underfunding situations. So without the research base, just a couple of observations. One is, I think as Rachel has said, the strength of the employer covenant is really important here. If thinking about continuing in a situation which you might not have expected to be in a few years ago. And I think we do have to be careful. I think the industry as a whole, experts within the industry as well, have a tendency to believe that the current situation and the current circumstances and the current environment will continue forever. And it generally gets us into difficulty at some point. So even if there is a surplus at the moment, considering how many years you've just spent underfunded, how certain are you that it really is a surplus and that it will be there at some point in the future? So I think you just need to be very careful about how you consider that decision or not.
So, I mean, I think that's a very fair point. Ultimately, you know, the safeguards are critical when it comes to this. I mean, what's your thoughts on what those safeguards need to look like?
So as I've outlined, a number of factors should be considered jointly between trustees and sponsoring employer before surplus can be used, and they include a buffer and a funding level, or first of all achieving a pretty prudent funding level, and then taking into account a buffer before surplus is used, looking at the investment strategy to ensure that reflects the changed situation in relation to the scheme, looking at the strength of the sponsoring employer covenant, as Chris has mentioned, and in some cases it may be appropriate, if there is going to be use of surplus, particularly by the sponsor, for that covenant to be strengthened in return for that. And then, of course, you don't just set these things up and let them run. You then need to have arrangements in place to govern and monitor them.
And I suppose if surpluses aren't returned to the employer, how else should they be used?
Well, of course, there's a consideration as to whether members should benefit from the surplus use, either together with the sponsor or alone. And there are provisions in many scheme rules for members' benefits to be increased. Those provisions could be used. What would be very helpful in these discussions would be if another option was possible, and that would require legislation, as I understand it, and that's the ability to be able to provide members with a one-off lump sum rather than increasing scheme liabilities by increasing pensions.
I agree with everything that Rachel and Chris have said it out very well. I think it's probably worth saying that there's a debate, and some schemes have the facility under their scheme rules now to use surplus to improve DC contributions, and potentially allowing that, given the relatively low level of DC contributions versus DB and some of the kind of intergenerational issues that potentially represents within employers and their workforce is worth looking at. I think we're expecting the DWP response on the surplus consultation in the next couple of weeks. From the conversations that we've had with them, we're kind of positive that they're going to land in the right place with a suitably permissive regime, but one that also has the important safeguards that Rachel and kind of Chris have set out to make sure that kind of members are protected. That trustees also, there's a statutory override, have the essentially the kind of whip hand on the decision and can engage therefore with employers about some of the kind of trade-offs, whether that's increasing member benefits first or taking additional contingent assets or asking for extra guarantees as part of the surplus. I think it's really important that the regulator also publishes supporting guidance to give trustees that confidence around the decision that they make, but also from the employer perspective to be really clear, because the regulator now has fairly draconian powers to intervene if they think there's been employer abuse. So employers also know that, where the safeguards are for them too, and we'd like to see those two things kind of come together.
We think it's really important that government proceeds in this area with extreme caution. Ultimately, the purpose of DB schemes is to pay members their retirement income for as long as they live. And so, in our view, trustees should really only, or the surplus should really only be returned once trustees have a very high level of certainty and a very high level of funding that the member benefits can be secured if the sponsor fails. And we would argue that the best way to do that is through insurance buyout. We'd also highlight that it's not necessarily certain that the government's objectives with surplus extraction will actually be met, because the government was very much talking about productive investment. And if a security buffer is taken away from the trustees, they may not necessarily be inclined to invest more aggressively and equally. Of course, it's desirable if employers take the money and invest it, for example, in R&D, but they could equally invest it in share buybacks. And so there's a fair few questions, I think, that need to be answered around there. But I think, as has been said by others, we believe it's really, really important that the trustees have a crucial role in all of this, and of course we recognise also that the scheme rules will very much vary from scheme to scheme, so there will also be differences there.
Thank you. So can I quickly follow up on the buffer point that was made? I mean, is there a general consensus around that, and does that need legislation, or is it something that could be implemented by schemes?
I think it's maybe too early to tell if there's a consensus. No doubt one will emerge. I think I would caution against prescription in that area, because every scheme is going to be different.
Any other points on that?
I think the main other point would be that it would need to be consistent with TPR's funding code, so people can kind of look across the piece together.
Lovely, thank you. Amanda Hack.
Sorry, have we missed number 12?
Oh, Frank did that one.
Frank did 11, apologies. The bill is expected to include legislation for super funds. The first pension scheme to transfer to a super fund was announced about a year and a half ago. So is legislation needed or is it too late?
It's absolutely needed. I mean, super funds are sophisticated financial institutions, for-profit financial institutions, just like banks, just like insurers. And just like those institutions, there needs to be a legislative basis for them, and it's not appropriate to carry on an interim basis with interim rules by the pensions regulator. We think that's really, really important.
So, PLSA first set out how we thought super funds could work all the way back in 2018, maybe even 2017. I kind of worked on that project. So I'm really keen to see the super fund regime put on a kind of statutory basis. I think it's very helpful for the point of ensuring that you've got a regulatory basis for operators, also to ensure that security for members, the regulatory regime is then fixed and set. I think it also will encourage new entrants to the market because the interim regime has shifted and moved over several years, and it will help that market to kind of grow and potentially kind of flourish over time. So really keen to see this kind of on the books finally.
Yeah, I would agree. I mean, I think certainty and clarity is very important in any area of pensions, and I think this is one. I think where we've seen the super fund transactions so far, they're a particular type of transaction in a particular type of super fund, and as Joe said, I don't think we've attracted all of the potential options into the market at this point. So something which clarifies exactly how that would work, rather than, as you say, having the movable feast that we've had with the regulations set within the regulator over the past few years would certainly help with that, I think.
Rachel, do you have anything to add?
And from a trustee perspective, anything which provides an alternative option to trustees to be able to secure members' benefits in full is to be welcomed, and therefore we welcome the initial transactions and also would agree that a legislative framework would be helpful.
Lovely, thank you. And at the moment, a super fund will only profit when a scheme secures buyout. So is there a model where a super fund makes profit before a buyout is sustainable?
So if that was to happen, as trustees, we would need to understand before transferring members' benefits to such a super fund that members' benefits would be suitably protected, and I think that points even more towards the need for a legislative and regulatory framework.
Could I perhaps just add on the broader point of the need for a legislative framework? There is, with super funds, there is a risk of regulatory arbitrage. We know that it's going to be a cheaper way to secure members' benefits than buyout. We completely appreciate why, because it's intended for a situation where the employer covenant is weaker and the employer can't secure buyout. So it's very important that the structures that are in place prevent gaming. So that's why we believe it's very important to have a gateway. That means that this is tested, that an employer who could actually go to buyout, and we note from the TPR's latest report, 54% of employers could. I mean, of course, that can change, as we know. But it's really important that they then use that route, because that route will deliver the most security for their members. And the other thing we think is really important is that it's possible for trustees to make an apples-to-apples comparison. And I'm not saying there should be the full Solvency II weight imposed on super funds. That's clearly nonsense, because otherwise then we wouldn't make any progress to the situation that we have now. But it needs to be possible for trustees to really make sense of the level of security they're getting for their members here and the level of security they're getting for their members there. And we believe that's really, really crucial.
Yeah, sorry, Joe, did you want to?
Yeah, just to add a couple of things. I think there's a variety of models that could be operated in the super fund space, providing the protections are there. I'll disagree slightly with Yvonne. Of course, she knows this on this point. I think this is about adding choice into the system. It isn't about regulatory arbitrage. This is a kind of pension fund solution for a pension fund problem per se. Super funds will be under the supervision of TPR, and they also have the backup of the PPF at the back end of that process, and the kind of regime that kind of wraps around that. I think it is important that and there's also no obligation on pension funds to go to buyout. There's a whole different set of things, and we must kind of recognise that. But I think ensuring the safeguards are in place to ensure that there is, if there is a kind of a profit element to new incoming super fund models, that the member protections are there. Trustees and employers who will be engaging with the process will have a kind of clear sense of what that means. And I think we should probably also recognise that profit comes in lots of different ways. You could have profit from operating the administration of super funds, which would be a lower level than the profit from gaining or sharing investment outperformance. So there are lots of different ways of cutting the cookie, but people being able to understand what that means is important. But I'm also confident that trustees and, of course, the professional investment advice they'll have to take to make those choices can do so.
Rachel, I don't know if you wanted to add anything.
Just really to reiterate what I started out with in response to that question, which is that it's helpful to trustees to have a full range of options to consider, and the individual circumstances of each scheme will differ. There will be schemes for which buyout is suitable and possible. There will be other schemes for which it isn't, and therefore a super fund regime is very helpful.
Chris, did you have anything to add?
No, I just think it's clear that there will be different circumstances. People will make different choices, and there's always trade-offs in pensions between the price, the certainty, anything else. So I think as long as those are made clear and explicit and people are aware of what option they're taking and the consequences of that, then I can see this as being a positive addition.
So is there sort of a risk of weaker protections without this regulation on super fund transitions? I think Joe, sort of you.
I mean, we have to. The regulator can operate within the regime that it has. I think that kind of certainty of the primary legislation and a full regulatory regime underneath that adds a lot more ballast to the system, and I think it gives trustees, it gives employers, it gives savers, and also gives providers, a really kind of clear sense of the operating regime. And I think having that on the statute books is really important.
If I could just add, I think it demonstrates that actually the drive from the various entities involved in those first transactions has been paramount in actually driving forward the regime itself. Actually, I think it would be, there is innovation everywhere in the industry, and it would be really helpful if the legislative and regulatory framework could mirror that and parallel that and keep up with it. And I think the next example of that is potentially collective defined contribution schemes, where there's lots of drive to make a real difference to members and not a regime yet.
Thank you. And how does easier surplus extraction fit into the super fund debate?
This is the sort of gaming kind of situation that I think is important to guard against. So if you have an employer that's funded above buyout, say, right? So you've got, as you know, it's sort of, you've got technical provisions, that's the base level, assets meet liabilities, then you've got a capital buffer, and then you can be funded up to buyout. So this is like sort of 3, if you like. If you're funded up to buyout, then you should secure buyout, because actually your members are in that position, and that will be the best outcome for them. What could happen with the surplus extraction is that basically an employer just extracts surplus to stay underneath so that that system can be gamed and they can get a cheaper and less secure option for their savers, which I think would be a poor outcome, which goes back to the gateway, etc., that I described earlier. So I think and that's why a legislative regime is so important, because you want to ensure that these things are clear, that they're not, as somebody said, a moving feast, and that also they've had the legislative scrutiny that goes along with primary legislation.
Thank you.
I think the point about choice and informed choice is important. Employers and schemes can make choices around the surplus returns that they might want to make or the trade-offs they might want to make about extraction. The same choices would apply to thinking about whether you go to a super fund, extract some surplus, or whether you go to an insurer. You will be moving from your pension fund to a super fund on the basis that you are as good or better off. The insurance regime will be further to the right of the more secure on that basis. But actually, you might be very comfortable that actually you feel that the super fund regime is robust enough for you, and that in some of the surplus choices that you could make in this theoretical world might be better for your employees generally, for the business generally, or you might be able to increase or enhance the benefits in the scheme. You would be, as it went into the super fund, you'd have to make other choices about whether you might get other increases by negotiations with the insurer, for example, but with less headroom, it's likely to be less generous. So I think there's a whole set of choices that will emerge in that space, but we're not there yet with any of it. So let's see the detail.
Thank you. Anyone else got any further points?
To the point made by Joe a little earlier, there is, of course, no obligation on trustees or employers to secure an insurance buyout for the pension scheme. That needs to be recognised. That said, it is a very common option because where schemes are sufficiently well funded, because it does achieve the ultimate security for members. I think schemes that where there's a discussion going on between buyout or run-on, that's because a scheme is going to be well funded already on a prudent basis. Those types of schemes I don't think are going to be the types of schemes typically considering super funds. I think the super fund option is largely going to be for schemes where they simply don't have the funding level to approach a buyout. So I hear what Yvonne is saying, but I don't necessarily see the same risks that she's outlined.
Thank you.
Lovely, thank you so much. That concludes the questions for our second panel. Order, order.